First of all, who are these all-in guys? And
Oh,
how are they interviewing this Treasury Secretary? And then they did Lutnick like 2 days later.
yep.
That
Yeah.
should be us. Oh,
Yeah,
they didn't even
that'll
know
be
what
us
they're
in a few
talking
years.
about.
Yeah, no, the All In podcast, I've been watching them for a few years now. I like them. Four guys, kind of California investor types, entrepreneurs. They cover a lot of, originally it was business. It was all business. They would talk about new technology that came on the scene, um, things like that. They started to get a little bit into the politics side, kind of a little bit later. And I think the access that they have now to the White House has to do with they call themselves the besties. So there's four of them, the four besties, and occasionally they'll invite in other besties that are sort of other kind of like angel investors, that kind of click.
As in like the podcast hosts?
The hosts, so there are four
Okay.
hosts,
No,
and
four besties.
four besties, but sometimes there's like a fifth bestie that shows up.
Ooh.
And one of them, the reason why I discovered them, the first case in the first place, was they interviewed Elon Musk a while back, and they're old friends with him, so they're like, again, part of the same Silicon
Back
Valley
before it was
sort of
cool to
investment
talk
side.
about Elon.
Yeah, no, I mean, so one of them, this guy Jason Calacanis or whatever, has known Elon since early 2000 or whatever, since before he even started Tesla. It's like, so that's
some deep
where they come from. Yeah. Anyway, one of them, this guy David Sachs, who's one of the besties, was pulled into the Trump administration. Essentially, he's the crypto czar.
Oh,
so I think he literally has an office in the White House, and so they were able to get access there, and that's how they did it. I think the keys to success, though, the reason why they're a lot of fun for me to watch, is that they're four very powerful, important people, but they still talk as though they're kind of like, I don't want to say kids, but they kind of take the piss out of each other.
Yeah, for sure. Because like
it's just very strange to see somebody who's so powerful get like insulted, and they just kind of like take it, or kind of like jabs. I think that's a big key to it. The chemistry between them. This becomes very obvious, I think, after like one of them leaves, even if just one is out for one reason or another. It's a different show, and it's not nearly as good of a show.
I think the Bessent one was the first one that I've seen.
Okay, yeah, you watched it. Yeah, so you kind of got a sense of it. They all kind of also have their own.
I mean, it was still very clear to me the whole time that they didn't really know what they were talking about. It should have been us there.
Yeah.
It's like they kind of knew what the Treasury market was, but they're a little confused.
Yeah. But anyway, I was watching the Bessent interview, and there were a lot of things in there that were said, that I was kind of aware of, but kind of wanted to drill into. That I wanted to learn a little bit more about and get some context on. And so that's really the source of this episode.
Yeah, that CBO scoring thing, which I think you're going to talk about.
Yeah.
I was and kind of still am like totally unfamiliar with what.
Totally unfamiliar. I didn't know. He just kind of mentioned it briefly. We'll watch the clip, and it was just really
kind of like
I didn't know what he was talking about
as I was listening, because I was like,
I don't know what he's talking about, but it's pretty crazy. He mentioned the Federal Reserve and how they might be threatening their own independence when going into some of these political areas like climate change and DEI. And that was interesting because you can almost listen to that, and it almost sounded like a threat. He's like, I want them to stay robust and independent, but they are threatening their independence when they do this. That was interesting. So I could have dug in and started seeing exactly what he might be talking about, trying to find example. Again, no time for this episode. The last thing I wanted to talk about, though, which is right up our alley, had to do with the capital charge to banks for buying treasuries. He's talking about getting rid of the supplementary leverage ratio. So we'll talk about that too.
Shame on me. I was in the investment business 35 years. I talk very confidently over that CBO scoring says this, and it turns out I didn't know what about CBO scoring. Like when you're on this side of the wall, you realize how crazy it is.
Right.
It's crazy.
It's quite a gameable system.
It's very gameable.
CBO, that's the Congressional Budget Office. And there's a law that was passed in 2010 called the Pay-As-You-Go Act, or PAYGO. And that was reinstated some rules that had lapsed after 2002 under Bush. So before that, it was called something like the Budget Enforcement Act of 1990. And the idea is that whenever Congress introduces a bill, the CBO is going to estimate the budgetary impact of that bill, so costs or savings to the budget over a 5 and a 10-year period. Now, for every congressional session, the CBO is going to track all the bills that were passed, and they maintain like a scorecard, a PAYGO scorecard, if you will. If a scorecard shows a net deficit increase at the end of a session, and there are like 2 congressional sessions a year, the Office of Management and Budget is required to issue a sequestration order, which is like an automatic cut basically across the board to balance the budget, right? Sounds good, right?
Does sound pretty good.
Sounds pretty good.
Very responsible.
I pulled the 2023 statutory pay-as-you-go report. And what I wanted to find was what he referred to, which was, after the tax cuts expire, it's going to be 2025. I wanted to see some like drastic increase in some number somewhere. This is kind of what it looks like. Apologies. All these reports put everything in such tiny print, but we're going to have to work with it. So this is kind of what they mean, right? There's the kind of the budgetary effects of kind of the legislation during that session. They have a 5-year PAYGO scorecard, and they have a 10-year PAYGO scorecard. And just looking at it, you can kind of see that like, okay, balances from previous sessions of Congress, and a positive number up here is an increase in the deficit. So positive number, bad. Negative number, good. That is a decrease in the deficit. And it looks like there's going to be this big, there's like a jump in the deficit in 2025. And you're kind of wondering, okay, is that the tax cuts expiring or something? But then this seems to like go down after that. And I was kind of looking at this, and things weren't really jumping out to me as to like where the tax cuts were or what exactly he was talking about.
So to be clear, so this is 2024. This is saying over the
2023.
Well, we're right. In this column, in the 2024 column, it's saying on the 5-year PAYGO, the deficit over the entirety of the federal government's $443 billion. And so we're jumping in 25 to $1.26 trillion.
I guess. Look, I don't want to linger too much on this. It's not super obvious, I think.
Okay. I'm just trying to understand because, that's
me too. Me too. But you can kind of see the structure of it. That's sort of what I want to highlight here. Okay. You can kind of see that the legislation that were enacted throughout the 118th Congress, and what they do for each one of them, they sort of, give it a hit to the budget. So again, negative number is good. This means we're going to like get money somehow. And then positive number is bad. That means they're going to go out. There was a Veterans Auto and Education Improvement Act, and then it gives a scorecard over the 5 and 10-year period. Right. And you can just see all the different acts that were passed during that Congress, right? Like here's a big one. The Fiscal Responsibility
all the others
Act of
are straight
2023.
zeros, though.
A lot of them, I guess, are acts that aren't expected to cost anything for whatever reason. You get it. But I was looking at this, and I still just kind of wanted to see where these tax cuts were. So here is the 2018 report. And, just kind of wanted to skip ahead here. And I was kind of expecting to see down here, maybe, all right, where's the tax cut act or whatever. And I can actually just see clearly, what the impact was supposed to be. And I was looking through it. I'm not one to read the footnotes all the time, but there was one that stood out here. And
footnotes, that's where some of the juiciest stuff can be sometimes.
It says the Bipartisan Budget Act of 2018 includes a provision that states, effective on the date of enactment of this act, the balances on the PAYGO cards established pursuant to paragraphs 4 and 5, blah, 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 of the act that, makes them have to make this PAYGO report shall be 0. Accordingly, these scorecards show the removal of the balances on the scorecards from laws enacted prior to the BBA. So I was like, wait a minute, am I reading this right? WTF, right?
What is that note?
What does that
referencing?
What does that mean?
Mm-hmm. Elimination of balances.
So boom, it's like elimination of balances pursuant to what we had just read from that act, and they just seem to like just zero it out.
It's gone.
There's no problem.
Fiscally responsible,
guys. We're doing it. How are you like, how do you balance your budget?
Quarter quadrillion. Who cares?
It's, so I even went ahead and I just was like, all right, I want to see this in the actual bill. Boom, there it is. They basically just legislate away all our problems. So this is the quote.
Balances of the PayGo scorecards established paragraph 4 shall be zero. Very, very to the point.
So when they start saying that this is gameable and this is crazy, maybe they're not quite doing this justice. So, there are other people who kind of track this, the budget. There are people out there who are more outraged about the budget deficits even than I am. And one of the main websites that track this, it's something called the Committee for Responsible Federal Budget. It's a .org, and they have this pretty cool website where they list out some of the crazy things, quote unquote, that the CBO does. And I think this example of all the things they list out here probably falls under the directing scorekeeping to favor chosen policies. Anyway, worth checking out. And apparently they can just kind of write new legislation that says, all right, let's just zero it out for the purposes of the scorecard.
That is obscene.
Yeah.
Like what?
Once I saw that, I just kind of stopped.
CBO
it just,
scorecards
I stopped looking to try to reconcile the Trump things. I don't know where these numbers come from. I'm not going to try to unwind them. It sounds like they can just,
because I think fundamentally, like, you just can't, like, at some points when things are just zeroed out, like there's no,
yeah. So,
there's no visible logic behind that.
So back to the Bessent interview. Yeah. Sound crazy. They seem very gameable. I think crazy so far, if I'm understanding this right, and I hope someone will correct me in the comments, that these are very gameable. The other thing is, if an emergency is declared, then the PayGo rules go out the door. So COVID, for instance, an emergency was declared, spend whatever they want, no PayGo to hold them back. My first take was, this is Congress. It's really felt, they write the laws. It reminded me of the Matrix, where Neo can just like write his own rules of reality. That's Congress.
Pretty much.
When you make the rules, you make the rules. They literally make the rules. And the check is the president. The president can say, I'm going to veto this. But pretty much you make the rules. And the president and the Constitution can stop you. The other thing that I got around this was the perception versus reality and conversation. I think that's been a theme, if I'm going to view this current administration with sort of past administrations, and specifically with Doge, which I've been following along very closely with, the idea of reality and perception, of actually getting things done, and the perception of getting things done. And you can imagine that when this was rolled out in 2010, right? What's that?
Perception versus reality.
What's the
difference, really?
When this was rolled out in we're feeling the difference. The difference is 36 trillion or whatever we are in debt. That's the difference.
Oh, that's the difference. Okay.
Oh, yeah, there it is. No, it's this sounded good when this was rolled out in 2010.
Yeah.
And I even went so far. I'm gonna show you a clip of Obama when he came out
in the
with
archives
this.
Now.
I went into the archives. Apparently, there is he gave a weekly address covered on C-SPAN 12 or something.
Wow.
But they're still up there.
That's pretty weak. Trump's typically daily.
All across America, people work hard to meet their responsibilities. You do your job, take care of your family, pay your bills. Sometimes, particularly in tough times like these, you have to make hard choices about where to spend and where to save. That's what being responsible means. It's a bedrock value of our country. And that ought to be a value that our government lives up to as well. Yet, over the past decade, this hasn't always been the case. 10 years ago, we had a big budget surplus with projected surpluses far into the future. 10 years later, those surpluses are gone. In fact, when I first walked through the door, the government's budget deficit stood at $1.3 trillion, with the budget gap over the next decade projected to be $8 trillion. But what also has made these large deficits possible was the end of a common sense rule called pay as you go. It's pretty simple. It says to Congress, you have to pay as you go. You can't spend a dollar unless you cut a dollar elsewhere. This is how a responsible family or business manages a budget. This is how a responsible government manages a budget as well. Last night, I signed the pay-as-you-go rule into law. Now Congress will have to pay for what it spends, just like everybody else.
I mean, so again, that's something that you can come out and you can sit and give a speech to and explain why it makes so much sense. You know, Congress can no longer spend a dollar somewhere where it's not either cut elsewhere or raising taxes. Easy sell. But in reality, that's not what happens. And that's the difference.
The way Obama outlined it sounds great, but at what point does the magic asterisk come in here? It's just completely nullifies.
It's a joke.
any
It's just kind of it's an annoyance, I imagine. That's what it feels like. Just briefly looking into this, it just feels like an annoyance for Congress to just kind of to work around. We got to put in 100 words or something.
Right.
Just to kind of knock it off or declare an emergency, and it's just fair game. How fast can you write the checks is seemingly the biggest limiting factor. So that's CBO. That's PAYGO. That's what he was talking about. Gameable, crazy. Looked into it a bit. Sounds right.
Safe, sound, and smart deregulation. Why are we doing this? Why are we doing that? And again, that there's a capital charge to banks for buying treasury bills.
Totally. Right.
So I actually think there's a chance that if we take, it's called the supplementary leverage ratio. If we take that away, it becomes a binding constraint on banks. We might actually pull treasury bill yields down by 30 to 70 basis points. Every basis point is $1 billion a year.
Can we talk about that for a second?
Yeah, let's talk about that for a second. Joe and we've decided that our audience are going to be intelligent professionals that are just not in the financial sector. So when they introduce something like this, there's no reason why we would expect everyday people who aren't in finance or something to know what the hell he's talking about. But what did he mean when he said that there's a capital charge for banks for buying treasury bills?
World of leverage ratios.
Yeah.
Pretty exciting stuff.
I'm going to try to do this as fast as possible. A bank's capital, think of it just as someone's equity. And there are regulations and laws that determine how much capital a bank needs to hold. Now, the definition for a well-capitalized bank is one that has a total risk-based capital ratio of over 10%. It has a tier 1 risk-based capital over 8%. Kind of ignore that. They're just measuring capital a little bit differently each time. But then they also introduce a leverage ratio, which I'll explain exactly what that is in a second. And then they also introduce a supplementary leverage ratio.
Just one's not enough.
They need to have they need to be over certain capital ratios. If they fall below a well-capitalized, they start falling to adequately or undercapitalized, then they become restricted by regulatory, the regulatory agencies will restrict what they can do. You can't start doing it's not fun.
Mm-hmm.
So
can't take on more risk, can't make more money.
So this is much easier. I think it's easier to explain this with an example. So we've got a super safe bank here, and this are what its assets are comprised of. It's got cash of 100 million. It's got some government securities, 200 million. It's got some mortgages of 500 million. So at this point, we would say that the bank is a $800 million bank, meaning its assets is a total of 800 million. The introduction of this concept of risk-weighted capital is an important one, because the idea is if we take a super safe bank and we say, okay, you need to hold 10% of capital, that means their equity needs to be 80 million, right? But that's not really fair, because what if we looked at another bank called YOLO Bank, and they had much riskier assets, right? YOLO Bank has deposits with other banks, which aren't too bad. They've got a bunch of corporate loans. They have unsecured consumer loans, right? And what if we said, okay, you're also going to have 10% capital? Well, that's not really the same thing, right? Because the super safe bank has got a lot more capital to protect against losses, which are most likely not going to happen, as opposed to YOLO Bank, which has much more riskier assets. So that's where this introduction of a risk-weighted total assets come into. And this is how it works. Let's look at Super Safe Bank real quick. Now, legally, like they come out and they give you a list of all these different asset classes with a risk weighting to it. So cash has a risk weight of 0%, right? There's no risk there. Government securities has a risk weight of 0%. Mortgages have a risk weight of 35%. So when you actually get down to it, Super Safe Bank has a risk weighted total assets, not of 800, but of 175. Okay. So at this point,
your risky assets.
That's kind of another way to think about it. This is like 175 million of risky assets, so to speak. Now, instead of needing, 80 million now of capital to hit the 10% minimum, all they need is 17.5 million of capital. So that's how much capital they would need to have in order to meet the 10%. By contrast, the deposits with banks, those are risk weighted at 20%. Corporate loans, risk weighted at 100%. Unsecured consumer loans, those are also 100%. So the risk weighted asset of YOLO Bank is much higher. So it's going to be 720. And now in order to reach the 10% number, they need to hold 72 million of capital, right? So, okay. So that's capital. Now, the thing is with capital, though, is you can imagine that the risk-weighted asset idea is a good one, but they need kind of a backstop as well. Because you can imagine if a bank had, 0 mortgages, right? And it was just government securities and a bunch of safe assets, then there's nothing stopping them from having, $1 trillion in assets, but their risk-weighted would still be 0. So there needs to still be we still need to look at the total assets number. And that's where the leverage ratio comes in. It does not look at risk-weighted asset. It looks at total assets. So in Super Safe Bank, the amount of capital needed to meet the leverage ratio requirement, again, the leverage ratio requirement in order to be considered well capitalized is over 5%. You would need the total asset number times that 5%, or you would need 40 million of capital, not the 17.5. Now, if you only had 17.5 million in capital, you would only have 2.2% of your leverage ratio, means you would be below that 5%. Meaning this bank, as it is now, if it only had, say, 20 million of capital, it would be constrained by the leverage ratio. The ratio that it's bumping up against, the first one, is going to be the leverage ratio. It needs to hold 40 million in order for it to fulfill this leverage ratio of 5%. Now at 40 million in capital, the bank has 23% capital ratio, which is huge.
Very well capitalized.
So so it's extremely well capitalized. Management would probably look at this and be like, we need to take on some riskier loans. This is nuts.
This is super
safe. We're leaving a lot on the table. It's super safe, whatever. Now, YOLO Bank, however, they are total capital ratio constrained because 5%, that 40 million would only get them to be a capital ratio at this risk-weighted asset number of 6%. So this, by contrast, they are total capital constrained. So when Bessent was talking about, these other banks, they are constrained by the leverage ratio. This is kind of what he's touching upon, right? And
the amount of risky assets that a bank wants to take on, all else equal, more risk is more return for your business. So fundamentally, you want to keep putting on more and more. And then these are kind of like the
But what he's saying here, though, it's not really about the risky assets. He's saying that banks want to hold more treasuries, which have, a 0% risk weight, but they can't. So they're going to start bumping up against this leverage ratio. And what he's saying is we need to remove that constraint so that we can increase demand for treasuries. That's what's playing here. What Bessent is describing is banks want to hold more treasuries, for instance, but they can't hold more treasuries without bumping up against that leverage ratio. If they remove, however, that constraint, then it might increase demand for treasuries because banks will be freed up to do so. We need to increase demand of these treasuries, and then we can start lowering the yield, which is seemingly kind of what they're really driving at. That's really what they want to do, is lower borrowing costs. And then he mentioned at the end, for every basis point, we could save a billion. And that's probably over the length of a year. So
I've got a pretty big hole to poke in that.
Go ahead.
So the thinking he's saying is that so you're constrained by these ratios. If you weren't, you could hold other securities. And he's saying treasuries in this case, which it's like right next to cash in terms of safeness. So you might own a little bit more, but the key point is this is where the interaction with the Fed comes in a little bit, because for everyday people, like if you just hold cash, you're not earning anything. If you buy a treasury bill, then you're going to get 4% or, wherever it is. But banks, everyone that's registered with the Fed, so all banks that operate in the US, they get paid interest by the Fed on the cash that they hold. So that's really the key point there, because in particular today, because the 10-year treasury yield is the main thing that Bessent talks about all the time, and rightly so. But I like last I checked, the 10-year treasury is like 4.3%, like 4.30. But banks are currently earning today 4.4% just on holding cash. So in this kind of environment, presumably there wouldn't be any additional demand for treasuries from banks, at least.
Okay, I can counter that a couple ways. First off, it's not going to be 4.3%. Or what are we at? 4.4% now at the Fed. Mm-hmm. It's not going to be that for 10 years, and no one thinks so. So if you wanted to get a treasury for 10 years, then at least you can lock in that interest rate over the 10-year period. The other thing, I don't, if he's got a binding constraint kind of on this leverage ratio thing, then it wouldn't matter if you wanted to hold cash or treasuries. The constraint is still there in that your total assets. One of the head scratchers I had when listening to it was a moment ago. We didn't show it in the clip, but just like a moment before that, he was speaking in the context of community banks. And then he switched over to the supplementary leverage ratio, which is not really for community banks. It's for much bigger banks. And the difference between the leverage ratio that I introduced to introduce that concept and the supplementary leverage ratio is the supplementary one, A, is for bigger banks, but it also includes off-balance sheet stuff. Another thing that sort of concerned me, that I would want to look into would be exactly how constrained there are. Like really? Normally, kind of in my understanding, no one really talks about the leverage ratio. It's always the total capital number that people talk about, suggesting that the constraint is not with the leverage ratio. And then the other thing is there's a question mark too about how much capital there really is to deploy that would happen if it were taken away, kind of at that margin that would be sent into treasuries to kind of push it down. And it's hard to get it's almost impossible to figure out sort of how much demand is needed to pull down rates by a certain amount. These are constantly changing. During the quantitative easing program, it would take about 600 billion in purchases of treasuries to drop yields by like 50 to 100 basis points, which is a lot and a little. 50 to 100 basis point drop is pretty good. That's a lot. But 100 billion is also a lot. And then one other point I think actually that you actually know more about, Joe, that had to do with, this is like a real life thing. So there's a story that happened when COVID, and there was, the regulators in 2020, shortly after COVID happened. So this was March, I think, or April of 2020, after the US financial system was flooded with a whole lot of liquidity. Banks went around and they went to the regulators and they said that we are running up against our leverage ratio. Because what happened was there was a huge flight to safety. So people, meaning like investors, so not necessarily banks per se, but investors, they sold,
like companies, institutional investors.
They just ran to cash. And there was a whole bunch of other cash getting pushed into the system. Mm-hmm. So now all of a sudden the bank accounts at those institutional investors, they blew up. So banks were now flush with a whole bunch of deposits. The Fed was putting in a whole bunch of cash into the system. And all of a sudden, the bank's balance sheets, they were growing a lot, but they were not growing the capital. Capital just doesn't accumulate that fast. Mm-hmm. And they were not running into total capital ratio problems. They were running into leverage ratio problems. And they went to the Federal Reserve and they said, listen, we have this problem. We can't do what you're asking us to do, which is like hold all these deposits. So what the regulators did was they said, okay, the cash and treasuries no longer count as assets, basically, to feed that leverage ratio number, and like fixed it. So they kind of like gave them a little write-off during that time. So now Bessent's kind of coming back and maybe making that more permanent.
One final point as well. We didn't really talk about it that much this time, but Bessent's also big on deregulation. The administration in general talks about deregulation. And whenever you overregulate, or, it's like we're saying here, whenever there's these rules that make you constrained, that in kind of an absurd sense, like banks can't take any more deposits, that's kind of strange, then banks are just inhibited from carrying out the activities that they would usually do. They right. provide a service to the economy, and then they can't do it anymore. One of those things is basically intermediating financial markets during times of stress. That's kind of what banks are there for. That's where they make the most of their money, because whenever everyone starts to panic during the COVID phase, like you were saying, everyone runs to cash. What that means is people are selling off other assets that they have. Could be, mortgage-backed securities, equities, riskier securities, riskier loans, whatever it may be. Banks, their day-to-day business model is to intermediate that. And so they're constrained by the amount of balance sheet that they have available to hold those assets that they intermediate between. So ideally, if they're, matching buyers and sellers, they're not holding it on their balance sheet for very long. Like they find a seller as soon as they have a buyer, and vice versa. But in times of stress, you really don't have, in times of stress, you only have sellers. You really don't have any buyers anymore. And that's the fundamental, in financial markets, that's the fundamental role that banks play. They are providing liquidity during these times whenever, everyone wants cash. No one wants anything. Everyone thinks the world's going to end. And so this is a similar thing that we saw there, is that banks weren't able to intermediate those anymore because they were constrained, for one major reason is because they were constrained by this supplementary leverage ratio. So that's like another reason that was cited as to why, after this was introduced, it was done on a temporary basis. While it was still there, everyone was like, we need to make this permanent. We need to make this permanent. But they didn't. So Bessent's kind of going back to, or that's another point that I'm sure that he's got somewhere in the back of his mind as he's talking about this.
Yep. Not like this is totally brand new, never been done before.
Mm-hmm.
All right. Good stuff. All right. Well, listen, thanks for tuning in. That's all I had to say. I had more to say, but I just didn't have time. Wanted to talk to about, like I said, his comments around the Fed's independence and kind of them getting into the political side of things, as well as lending being pushed outside of the bank system. But who knows? Maybe it'll come up again and we can cover it. But we're already over plenty of time. So thanks for spending your time with us. Shout out again to our subscribers. You're the best. And we'll see you next week.
See you next time.